Hello everyone, welcome back to Fundrise Finance. In today's video, we are going to talk about dividend ETFs. One should consider adding to their portfolio. As we have discussed in our previous videos, dividend stocks, when chosen efficiently, provide a good platform for the portfolio to appreciate and also pay healthy dividends on a regular basis. But one should also take care not to have too many stocks in their portfolio as it defeats the purpose of diversification. An overly diversified portfolio is just as bad as an under-diversified one. An ideal portfolio should have a minimum of 5 to 10 holdings and a max of 20 to 25 holdings. With such criteria, how can one get the benefits of dividend stocks and also not bloat their portfolio? This is where dividend ETFs come into picture. With such ETFs, investors can instantly diversify their portfolio into many companies at once. Individually, an investor is not expected to keep track of each sector and all the companies in it. Dividend ETFs reduce that burden, which is another big advantage. Let's look at a few such ETFs today that investors should consider adding to their portfolio. While selecting these ETFs, the criteria I used were 1. Good appreciation over the past 1, 5, and 10 years so that the portfolio also can benefit from the rise. 2. Good dividend growth rates, meaning the dividends are also increasing each year at least at the rate of inflation so that the returns are secure. 3. Yield being higher than S&P 500. 4. They should be cheap so that their cost does not eat into the returns. The first one we have is SPYD, which is a Spider Portfolio S&P 500 High Dividend ETF. This ETF is extremely cheap at just 0.07% as the expense ratio. The way this ETF works is it selects the top 80 high dividend yielding companies within the S&P 500. And you can see this ETF was launched almost 6 years ago in October of 2015. Here we come to ETF.com to see the details of this ETF. We see that the fund ranks all the dividend pairs in the S&P 500 by yield and selects the top 80. When we look at the sector breakdown, we see it is fairly spread across financials, real estate, energy, utilities. These are the sectors which typically pay dividends more than your information technology and consumer discretionary areas. When you look at the top holdings, that we see Organon, Omnicom, Philip Morris, Newell Brands, Valero Energy, Marathon Petroleum, M&T Bank, EOG Resources, AbbVie, Bristol Myers Squibb Company. We come here to Seeking Alpha to see other performances. SPYD has a yield of 3.62%. So year to date, it has given 1.88%. For the last year, it's over 18%. For the 5 years, it is like more than 20%. Now, 10 years may not be correct because it just started in late 2015. Next in our list is HDV, which is the iShares Core High Dividend ETF. This is again a very low cost ETF at just 0.08% as expense ratio. What it does is exposure to established high quality US companies, access to 75 dividend paying domestic stocks that have been screened for financial health. This is where it slightly differs from the SPYD. SPYD just bluntly goes and selects the top 80 of the highest paying companies in S&P 500, whereas HDV does add few more filters to the selection criteria. The index that HDV uses is the Morningstar Dividend Yield Focus Index, and the number of holdings in this ETF is 75. Let's look at the top holdings of this ETF. We see ExxonMobil, Chevron, Verizon, Johnson & Johnson, AbbVie, Philip Morris, Procter & Gamble, Pfizer, Coca-Cola, and Merck. These are some of the very, very good dividend companies to consider even for your individual portfolio. Looking at the sector exposures, you see healthcare is at the highest, almost 1/4 of the portfolio. Then you see energy, consumer staples, information technology. As you can see, it slightly differs from the SPYD that we just looked earlier, where it was mostly focusing on the financials and the energy and the utilities. Here it's a different way because of the filters being applied. When we go into the specifics, the yield of HDV is 3.42%. Year to date, it has given 1.7%. Last 1 year, it has 13.02. Last 5 years, it has 22.8. Last 10 years, it has given us like almost 84%. Next on our list is VIG, the Vanguard Dividend Appreciation ETF from Vanguard. VIG has an expense ratio again very low of 0.06%. This seeks to track the performance of the S&P US Dividend Growers Index. It focuses on large cap equity stocks with a record of growing their dividends year over year. Here on ETF.com, we can see it focuses on firms that have increased their dividend payments for the past 10 years. So WIG is more of a play safe ETF, which considers companies which are large and constantly growing their dividends year after year. VIG has a 267 holdings in it, which is a good amount of companies to diversify. And the top 10 has Microsoft, Johnson& Johnson, United Health Group, JP Morgan, Procter& Gamble, Home Depot, Visa, Pepsi, Broadcom, and Coca-Cola. When you look at the sector breakup, we see consumer discretionary is at 15.4, then we have industrials at 21.1. When you go into the specifics, VIG has a yield of 1.68%, which is just above the S&P 500. And year to date, it has given us minus 7.85%. For last year, 11.12. For 5 years, it's 76.31, and for 10 years, it has given us 175.2%. VIG has a 5-year growth rate of 7.82%, which is higher than the current inflation that we have of 7.25, and it has been growing dividends for the last 8 years. Next on our ETF list is VYM, which is the Vanguard High Dividend Yield ETF. This tracks the FTSE High Dividend Yield Index and has a very less expense ratio of 0.06%. The logic of VYM ETF is that when selecting the companies in it, it orders them by forecast dividends over the next 12 months, and then they are weighted by market cap rather than the dividends. So you see here, basically, by ordering these companies in such a way, what it does is it's not really targeting a high yield company. So though by name it is called high dividend yield ETF, it still offers a fairly low yield of 2.77%. When you look at the number of stocks it has 410. And the top stocks are again the ones that we want to see, basically the high quality ones, which are J&J, JP Morgan, Home Depot, Procter& Gamble, Bank of America, ExxonMobil, Pfizer, Chevron, AbbVie, and PepsiCo. From a sector breakdown perspective, financials is the top player in here with 21.7. Then we see consumer staples and healthcare. From a performance standpoint, year to date, it has fallen minus 1.69%. 1 year is 14.75. 5 years is 41.71. And for 10 years, it has been like 132%, which is really good. The 5-year growth rate is again 7%, which is good. Dividend growth has been for the last 11 years. VYM is a very good ETF for one to consider. It has a broad basket of over 400 holdings with a decent growth rate, good yield of over 2.5%. The next ETF in our list is DGRO, which is iShares Core Dividend Growth ETF. The primary goal of this is to focus on companies that have a history of sustained dividend growth and that are broadly diversified across industries. This one again has an expense ratio of just 0.08%. The logic that DGRO uses to identify its stocks is it picks up those companies which have been steadily increasing their dividends for the past 5 years, and also the payout ratio not to be more than 75%, which is really good because anything beyond 75% is a risky approach because the companies may or may not be able to sustain the dividends in the future. Both these factors are aiming for sustainable growth of their dividend. Here we see the index it tracks is the Morningstar US Dividend Growth Index, and it has 418 holdings. When we look at the top 10, we see J&J, Procter& Gamble, Apple, JP Morgan, Microsoft, Pfizer, Coca-Cola, Merck, Bank of America, and Cisco Systems. And at the sector breakdown, we see financials being the highest at 21. Then we have information technology, healthcare, industrials, consumer staples. So among all the ETFs that we have seen so far, DGRO has the highest exposure to information technology because it also has Microsoft and Apple. Coming to the details of this ETF, coming to the performance of this ETF, it has a current dividend yield of 2.04%, and year to date it has fallen just over 5%. For the last year, 13.5. For 5 years, it is 72.5, and for the last 10 years is not correct because it has just started in 2014. When you look at the specific growth details of the ETF, it has a 5-year growth rate of an excellent 10.3% and dividend growth of 7%. So this growth rate is really, really good. It is beating the inflation handily. The DGRO is one of those ETFs which an investor should consider to add to their portfolio. The last one that we have in our list is the most popular one, which is the Schwab US Dividend ETF. Symbol is SEHD, which has very less expense ratio of 0.06%, and this ETF that tracks the Dow Jones US Dividend 100 Index. SEHD uses the logic of selecting only those firms which are increasing their dividends over a 10-year history. Along with that, we see it applies the filters like cash flow to debt ratio, return on equity, dividend yield, and dividend growth rate. So these are some good filters that the fund applies. This ETF has 105 holdings, with the top 10 being Coca-Cola, Verizon, Merck, Amgen, PepsiCo, Broadcom, Cisco, Pfizer, IBM, and Home Depot. And you look at the sector breakdown, financials and information technology are neck and neck at just over 21%. And then we have consumer staples and industrials close by to each at around 14%, and then healthcare just behind at around 13%. Looking at the performance details, it currently yields 2.91%, and year to date it has fallen over 4%. For last year, it has given 15% return, 74% for the last 5 years, and 183% for the last 10 years. And look at the dividend growth. The last 5-year dividend growth rate has been an amazing 12.3%, and the dividend growth of 9 years. In my opinion, SCHD is an amazing ETF. It has multiple filters put in place to select the dividend stocks. So all these filters really, really help in weeding out those companies which are giving high yield just for the sake of it. Here we summarize all the ETFs that we discussed in this video. So all these ETFs are extremely low expense ETFs, giving good yield, much higher than the S&P 500, and they provide a very good diversification to one's portfolio across all the sectors and companies. I hope this video has been helpful in getting to know the different dividend ETFs that one should consider to add to their portfolio. Thanks for watching. If you have liked this video, I would appreciate if you could leave a comment on how you felt about this video and what you would like to see in the future. Please like and subscribe to my channel to keep informed about all such informative videos in the future. I am not a financial advisor, and all the content you would see in this channel is for educational and entertainment purposes only. Everyone should do their own due diligence before investing their hard-earned money. See you all in the next video.